Boys, welcome back to the next video of the series. Now, what we're going to talk about today is probably going to be the most complicated, nuanced concept of the whole series, but I'm going to do my best to explain how I got to this and what it is. It's called effective structures. But before I get into it, if I give you value, please chuck a like, chuck a subscribe, and let's get into it. So, effective structures is essentially getting rid of outlier data to see the true structures that are forming, and directionality, which can look like this. So let's say you have a structure like this. The idea of seeing the effective structure is getting rid of all the bullshit and just seeing the interior data. So being able to see something like this and getting rid of all of this information here. So you can see where the actual accumulation is happening. So if we take another example, you can have disguised direction. So if you have some sort of accumulation that is looking like this, I know that this is going to break down. And it is different to just calling it a channel, because what we're trying to do is understand that there's a strong accumulation going on in the center of this. Because if we get rid of all of this information here, really all of the positions are in this range right here. And we'll get into examples in a sec, but we just need to get these kind of ideas down first. So another way that you can have it is seeing unnatural movement where something should have broken. So let's say, for example, we have a pennant. So let's just have something super simple, something like this. And then you see a little micro-accum going on here. So traditionally, you would have taken that short, but let's say you are in that position. If you saw this micro-accumulation, you would want to exit because really, it's finishing the pennant. And this just becomes outlier data because the effective structure is this. So if you did short here, you can exit, break even, enter again here, and expect this to break up. And really, all of this information, all it's doing is filling big positions. So the difference between a structure that looks like this, where you're building healthy OI here, healthy OI here. When it breaks up here, it breaks up. The difference between this and seeing this to break down is that every time we grab this, it's filling shorts. So this is just a massive accumulation of shorts to break down, which is the same thing as this when you have like a liquidity grab or whatever, because it's a way to fill positions. So this is basically the same example that I just drew. If you see a structure like this forming and you're saying, okay, you know what? This is actually really strong. There's a lot of buy pressure. It's actually the wrong bias. Because if you see how strong these wicks are on either side, so this bit, this section, this here, and you just draw the effective structure, which are these purple lines here, it's actually very overextended. Because really, there's this massive accumulation going on here of shorts, and they're leaving this gap here where there's no buyers. So eventually, this has to break to fill these buy positions. Because these wicks are keeping it in the short range to disallow anyone to buy in here properly, and actually accumulate a decent position. And then ideally, and normally, we would get some sort of fractal catalyst at the end here, and then we can take this short. So when you see something like this forming, it's more important to understand why it's forming than just seeing it on the chart. Because you want to know that these wicks are all just bullshit, and this is a massive short accumulation going here, so it's going to dump. And we can see a few examples of that here. So something like this, for example. Off the bat, you can already see that there's this gap of liquidity around here, because it's just this kind of bullshit overextended form. But the question is, where are most of the positions actually getting accumulated? And then if you draw the effective structure, you can see with these pink lines, it's really grabbing just this critical accumulation range here and getting rid of all of these wicks. Because what they're doing is filling a massive short position here, which leads to this massive move. And then obviously there's context there, because you can't just take these little isolated moments. It has to be in the context of the bigger picture, which is actually this. So that whole section was this continuation pattern here, where we've seen there's a center axis of this range here. We've kind of not really held it very well, come up, and now we're filling a massive short, confirms it here, and then the massive break. But the important thing to be able to visualize is this effective structure. Because if you want it to be a truly healthy accumulation, you need a decent amount of time on the bottom side. Which is why, as I talked about before, if you have healthy accumulations and micro accumulations, good health, you will create this OI that will break and create a liquidation cascade. As opposed to something like this, where every time it's swinging this high, you're using retail breakout traders or whatever as your entry liquidity. So it's kind of an ascending channel, but it's also more important to understand that the positions are in the center of this range. And these wicks are old as bullshit. You'll eventually get a catalyst you can short. So this is actually a screenshot from one of my old notes. And you can see here, this is what I said. If this was healthy, this would have gone up, tapped supply, and come back down to confirm. The fact that we have this disguised channel shows that shorts are being entered heavily before a macro break downwards. So basically what I'm saying is, if this was healthy, we should have had this, tapped supply, come down, and continue to accumulate on the bottom side for a break up. But instead, we've come down, barely touched it, and now we just have this bullshit, which eventually breaks, confirms, and then this is our short. for this whole move. And then you can see another section here where we have the same idea of an effective structure again. So in here, this really should not have happened because we had this major interior trend here. This should have been a super clean break, but instead we've had this structure here, and instead of being a clean break, we've just had this disgusting like downtrend here. And if we get rid of the outlier data, I know that this is just going to break down. And if it breaks up, we can take that position too. But because of the context of this uptrend, I know it's going to break down. Now, this is another and completely different example of an effective structure. Because if you're looking at a chart like this, you're probably separating it all. So you're seeing this section, and then you're seeing like this section, whatever. The idea is to be able to see through all of this and understand what is effectively going on. Where are the positions, who's entering? Which leads to being able to see this instead. So really, we have this massive pennant, and this is just all outlying data, and we can see how accurate this pennant actually is, and then we get this catalyst in here, which leads to an incredibly strong break. And that's a perfect fucking entry, basically no risk, massive reward. And then there's also another part because I know that this is a very common structure, but it's more about being able to visualize what's actually going on here. Now, the most common way that I use effective structures isn't to see the macro form that's going on, it's more so in consolidations to see if it's strong or weak. So if I'm trying to evaluate this structure here, and I'm wondering, okay, is this consolidation going to break up or down? Effective structures and being able to see all of this in the middle can tell me, okay, because this is all pushing up, filling shorts, grabbing liquidity, I know that all of these are unhealthy, this is probably going to break down, so I can prepare for a short, and I can get ready to see a fractal catalyst, take an entry, and then take this trade here. So I'll show you two examples here that are very similar, but one of them is strong, and one of them is weak. And we can see the difference between the two with effective structures in seeing strength versus weakness. So, let's have a look at this example here. So we do have this ascending kind of channel, but the question is it bullish or is it bearish? Like, what other information can we take in to understand what's going on here? And even just visually, you can probably start to say, okay, well, there's clearly like an origin in here that was tapped twice pretty cleanly, broke up, confirmed. We're pushing up here. This is also healthy. This is all good. Kind of like the center axis of this pushes up. I personally would actually be bullish because it's not just about the macro structure, but it's more so about all of these structures. And this is all pushing upwards. And you can see a very clean drawing of that here. So it's all very strong, healthy accumulations breaking upwards the whole time. Even though we have this macro kind of effective structure that would normally be bad. Now, if we take a very similar structure, this is showing a very different picture by looking at fractal information. So in the same kind of light, we also have this ascending channel, but it's not just about that. It's about seeing the micro information. And if we start to look at this differently, we say, okay, like this isn't great. This really isn't great. I mean, there's kind of like an accumulation here, but this grabs. This is grabbing again. This is unhealthy. Grabs, fractal catalyst here, and then breaks down. And then again, you can see that very cleanly drawn right here. So the difference is being able to see these microstructures in here, which are all incredibly unhealthy, and we can get a fucking god short, ridiculous RR, breaks the whole structure. And we can look at a few more examples too. Like here's another example of a really terrible effective structure, because all of this information here is just trying to get it back into the range to accumulate shorts. And then eventually we get this ridiculous trade. And if you zoom in here, you can see that there's actually this overextension here, which would be an effective structure like this. We take this short, and this is just death. And then all of these trades are focused on getting these ridiculously high RR positions, which are basically no SL or break even, which you can't get any other way of trading. Now, this is an example from a while ago, but someone asked me, why didn't I take any position in here? Like, we've had this breakdown, we've had one consolidation, we've broken down from that. Why isn't this a spot to enter? And I told them it's because of effective structures. Because if we look at this much more closely, I know this is like low res, but if we just go like this, all of these periods here are all very negative. Like this is all ascending, this is ascending again here. We've grabbed liquidity twice here, we grab this whole liquidity again. And because this whole consolidation is actually in here, I know that this is just going to break down. So I left it. Now maybe I took a long here as a little scalp and then I saw this, exited, and then that's when my bias started to form. And then from there on, I just wait. And because it keeps forming like this, I just waited, and then eventually we had a leg down, and then we finally got a healthy structure where we had this was my trade, and I took this. So yeah, being able to see the hidden information in charts can give you totally different bias that you wouldn't be able to see otherwise. Now, I wouldn't necessarily say practice this, but in a few videos time, we're going to start evaluating charts, going through positions, seeing why we wouldn't take trades or why we would, and using effective structures is going to be a part of that to evaluate our positions. And that's all I got. Until laters.